On this episode of Ask the Experts, I'm sitting here with Kanwal Sarai from Ottawa, Ontario. How are you?
Good, good. Thank you for having me on, Rick.
You're very welcome. Kanwal, you're with simplyinvesting.com. Tell me a little bit about it.
Sure, absolutely. So simplyinvesting.com, this is a company that I started. And my mission in life is to educate people on how to invest responsibly and safely and successfully. And so I have an online course, and I tell people it's so easy that a 9-year-old could do it. I had both of my kids, when they were 9. They took the course. They're 14 and 18 now, and they've been investing for many years, and they each have their own stock portfolio. So the name says it all, simply investing. It is really that simple. It's not rocket science. And so I love to teach, and I love to get people educated on how to invest.
I talk about financial independence in the sense of, saving, budgeting, earning a little bit more money, investing your surplus. What is it about simply investing? Like, what are the pillars that make it simple?
Yeah, absolutely. So, I have a rule. Number one, there's no jargon. There's no technical jargon at all. So in the online course and when I teach in person, once this COVID is over and we're back to live seminars. So number one rule, there's no technical jargon, simple, plain English. And my philosophy, and it's not something I invented, it's been around for many, many years. It's the dividend value investment approach. So I call myself a dividend value investor. So I can explain what that means. Yep. You may know, and your audience may know, dividend investors. So what do? They invest in stocks that pay dividends, right? What do value investors do? They invest in stocks that are undervalued or priced low. So I take those two and I put them together, the best of both worlds. And so what I do is I look for quality dividend paying stocks that are also priced low, that are undervalued.
I see. So when everyone else is selling, are you buying?
If it's a quality stock, if it pays a dividend, and if it's undervalued, yes.
All right. What is a quality stock?
Great question. And so what I do is, and I can send a link to you afterwards. You can
we'll definitely put the links in the description.
Yeah. So your question was, how do you know that it's quality stock? And I'm going to expand on that a little bit. How do you know that when you're looking at a stock, how do you know it's a quality stock and that it's undervalued? So to help you with that, I've created what I call the 12 rules of simply investing. So I'll send you a link to that. It's up on my website. Everybody can see it. But what I'd like to do today is, if we have like 5-10 minutes here, I'd like to just go through the 12 rules really quickly.
Sure.
With your audience, because I think they'll get a lot of value out of it. Normally this is a 2.5-hour course. It's online. We go through it in detail. We have real world examples, and we take you through the 12 rules. But let's go through it now.
We can do the Cole's Notes version and take all the time that you want.
Absolutely. That would be fantastic.
Great.
So rule number 1, do you understand the product or service offered by the company? And it doesn't mean you have to be a subject matter expert and you got to spend hours and hours trying to figure this out. But you got to be able to explain it to your grandmother or explain it to a 12-year-old, what a company is doing to earn profits. For example, how does Walmart make money?
Yep.
I'll ask you that.
Yeah, they sell stuff for cheaper than everybody else.
Absolutely, right? They're buying stuff at wholesale prices and putting it in their stores and selling it at retail prices.
Right.
How does McDonald's make money? They sell food. Right. So just a general idea of that. And then that's enough to satisfy rule number 1. Now, here's the thing. If a company fails even one of the 12 rules, we don't invest in it.
Really?
We skip it. We move on. So that's what I've been doing for the last 21 years as a dividend value investor. And it works. It works. Right. So the rules here are designed to save you time and to minimize your risk and maximize your gains. Right. You work hard for your money. We don't want to put that at risk. So we want to lower the risk as much as possible. Okay, so let's move on to rule number 2. Will people still be using this product or service in 20 years? Right? So you can think of things that people still need to eat. People still will need some form of, telecommunications, banking,
Sure.
financial services, mortgage,
Sure.
and, so we'll need all of these things. And again, I said this before, we don't want to put your money at risk. So when you're investing in a company, you want to make sure the company is going to be around for a very long time and that they're going to be still in business, right?
Yes.
So that's rule number 2. Rule number 3, does the company have a low cost competitive advantage? Now, the best example, I'm going to copy Warren Buffett's example, and I'm going to use that, where he talks about, think of a company, a corporation as a castle. And around the castle, you've got a moat. And the wider the moat and the deeper the moat is, the better the company is going to be able to defend itself against competitors. Mm-hmm. So a quick example, if you look at a company like Coca-Cola, they've been around for over 100 years. They operate in over 130 countries. You can take that Coca-Cola logo anywhere in the world and show it to somebody and they'll know exactly what you're talking about. If you were to start a soft drink company today from scratch, you would have to spend billions and billions of dollars in advertising and marketing, and you still wouldn't get to where they are today.
Right.
So they have a very good competitive advantage and a low cost advantage. Okay, rule number 4, is the company recession-proof? So Rick, let me ask you this. If there's a chance you may lose your job, or we're in the middle of a recession, are you going to go out and buy a new car?
Probably not. But Coca-Cola, if I'm a Coke drinker, sure, why not?
That's right. Yeah.
Yeah. And I'll still be shopping at Walmart.
There you go. And a similar question along the same lines, if there's a chance you may lose your job, or there's a recession, or you've lost your job, you're not going to take an expensive vacation overseas with your family, right? You're not going to do that. So that's why we don't invest in car manufacturers. We don't invest in airlines. And we saw this happen just last year with COVID. General Motors cut the dividend to 0. Boeing cut the dividend to 0, right? They're building commercial aircraft. So we don't want to invest in companies that are not recession-proof. So just like you said, even if you've lost your job, you're still going to have a Coke.
Sure.
When you come home at night, you got to turn the lights on.
That's right.
Right? You still have to eat. You still have to use toothpaste, toilet paper. Here in Canada or in places where it's cold, in the winter, you got to heat your home.
That's right.
And you still need to do those things. So the companies that provide those products and services, right, even when there's a recession, they are going to continue to earn, they're going to be profitable. And as long as their earnings are growing, they will continue to pay dividends. I just wanted to mention quickly for your audience, I know you know what dividends are, Rick, and I'm sure a lot of your audience does, but let's just make sure we're on the same page here. So if a company is paying a dividend, right, let's say an example of a company is paying you a $1 dividend per share. You own 1,000 shares, you'll get $1,000 in cash for as long as you own those shares and as long as the company continues to pay the dividend. The dividends, like I said, is cash. It gets deposited directly into your trading account. And you can spend the money if you wish, or you can reinvest it. It's entirely up to you. So that's what a dividend is. I wanted to get that out of the way.
And do you recommend reinvesting, or do you recommend just blowing it, just spending it?
Yeah, great question, Rick. And I'd like to get to that question after the 12 rules.
Sounds good. Okay.
Yeah.
All right. Good.
Okay. Rule number 5. Does the company have consistent earnings growth? Right. So we're looking over the last 10, 15, 20 years. We want to see the earnings growing at least 8% or more. So if you put it up on a graph, and you can get this anywhere, Yahoo Finance, MSN Money, I want to see the earnings going up like this.
So can you specifically define earnings? Are you talking about revenue, like the amount of, or are you talking about net earnings, like bottom line?
Yeah, great question. So we look at the earnings per share, the EPS, which is essentially the bottom line. And so we want to see the EPS going up. So if I look at a graph and the EPS is doing this, I don't want to invest in that company. It fails rule number 5. That's how simple this is.
It's very simple.
If I look at the graph and it's doing this, it's up and down, it's down, it's up and down, it's completely random. I look at that graph, I have no idea what the company is going to do next year or in the next 5 years.
Sure.
So it fails rule number 5. I skip it. I move on to something else. That's how simple it is. Rule number 6. Does the company have consistent dividend growth? So same thing. We want to look at a dividend growth over the last 10, 15, 20 years. We want to see the graph. We want to see it going up like this. I'll give you a quick example. Coca-Cola has had 57 years of consecutive dividend increases.
Annually.
Okay. Annually. Everybody knows about Johnson. Go ahead, Rick.
No, I was just going to say, wow, that's incredible. So you start with X today, and next year it's going to be a little bit more, and the year after that it's going to be a little bit more.
That's right. And every time the dividend goes up, there's more money in your pocket, right? There's more, it's cash. It's coming to you directly from the company. If you look at a company like Johnson & Johnson, 58 years of consecutive dividend increases. Look at Procter & Gamble. So they're the ones who make Tide and, Gillette and all these things. Procter & Gamble, 63 years of consecutive dividend increases. They have been paying dividends since 1890. I'm going to say that again. Procter & Gamble has been paying dividends since 1890. Coca-Cola started a little later in 1893.
Incredible.
Okay, so nobody can predict the future. I can't do that. You can't do that.
No.
I don't know if there's going to be a recession next year or in the next 12 months, in the next 5 years. Nobody knows what the stock market is going to do. But when I look at a company like Procter & Gamble, Johnson & Johnson, Coca-Cola, I can have a very high degree of confidence that these companies are going to continue to pay me a dividend and increase the dividend in the future.
Right.
Does that make sense?
That makes perfect sense to me. I didn't realize 1800s. Wow, that's incredible.
Yeah. Yeah, it's unbelievable. So rule number 6 is really important, right? But they're all important, but we want to make sure that the dividend coming in, because Rick, at the end of the day, this is my opinion, but I really believe this. At the end of the day, it's the dividends that are going to cover your living expenses, right? In 20, 30, 40 years from now.
Right.
Right. And I have clients who have done this sooner. I have clients who are making $65,000, $70,000 a year in dividends alone. And in Canada, in the province of Ontario, you can make upwards, I believe I had a number here somewhere.
It's about $50K a year, I know, per person.
Tax-free.
Yeah,
tax-free.
That's incredible.
That's right. Think about how much your income has to be to earn $55,000 tax-free.
I know.
Right. So there's a huge advantage to the dividends. And so without the dividend, you're only hoping for the stock price to go up. And hope is not going to cover your living expenses. It's not going to cover your hydro bill or your gas bill.
Sure.
Right. So the dividends, I can actually use that as cash and cover my rent and all these things eventually. Okay. Rule number 7. Now we want to look at the payout ratio. Okay. And the payout ratio is really simple. It is the dividend divided by the earnings per share. So let me give you an example. Let's say a company the EPS is $3 a share. Okay. And the company is paying a dividend of $1 per share. That's really good, right? The company
33%?
earns that's right. 33% of what they earn, they pay back to the shareholders. What do they do with the rest of the money? They reinvest it back into the company to grow the business. So that's really good. Let me give you a bad example. Let's say a company is earning EPS is $3, but they're paying a dividend of $3.50.
Yes, I remember a company like this. Do you remember Crescent Point Energy?
I recognize the name, yes. Did they do this?
Well, they used to borrow from the bank to pay their dividends.
Yes, it was
crazy.
Incredible.
It was incredible. I mean, and then of course, when the oil, when the oil crisis hit, it was at around 2014, I guess. That all stopped.
Yeah, so that's crazy. It's insane. Yeah. And there's companies today, right now, you can go onto Yahoo Finance or whatever and look at some of these companies. There's not a lot, but there are companies where their dividend is more than what their EPS is.
That is really
which is crazy.
Advice. Yeah, I love number 7. I love number. I'm gonna start checking now. This is really good advice.
Yeah. So number 7, we cut it off at 75% or less. Like that's what we want a company to have a payout ratio of 75% or less. So if you're at over 100%, that's bad news. Right. But anything over 75 is risky because now the dividend might be at risk. Right. So in the example I just gave you with the bad example where the payout was over 100%, most likely the company is going to have to cut its dividend. And forget about any dividend increases. That's never going to happen. right?
Right, exactly.
Unless they can get the earnings back up again. But that's a risk we don't want to take with rule number 7.
Yeah.
We just move on to something else. Okay.
Fair.
Does that make sense?
It makes perfect sense to me. I'm going to be checking it out later.
Awesome. Rule number 8, does the company have low debt?
Mm-hmm.
Okay. There's companies out there today that have a debt of like 10%, 20%, 0%. There's companies with no debt whatsoever on their balance sheets. 0.
10% of what?
So we look at the, I'm looking at the formula here. It's the long-term debt over equity.
Okay. So
Company's equity.
how would I be able to decipher that if, let's say, I was looking at a stock on Procter and Gamble on Yahoo Finance? How would I how would I be able to see how much debt they have? Yeah,
absolutely. Great question. So even on Yahoo Finance, I use Morningstar. If your audience is a US or Canadian, the US folks go to morningstar.com. Canadians go to morningstar.ca. But Yahoo Finance has the data as well. Morningstar just goes back 10 years, which is fantastic.
Okay.
And it's free.
Wow.
So to answer your question, go straight to the balance sheet. You're going to see a line item there that says long-term debt. Take that number and then divide it by the shareholder equity.
Right.
That's also in the balance sheet. So you'll see that. Yeah. So just to make this really simple, Rick, if you were looking at 2 companies, so company A, company B. Company A, all things considered equal, they're both, 2 companies are the same industry, same sector, same payout ratio, same dividend. This company has a debt of 5%. This company has a debt of 400%.
Right.
Which one are you going to invest in?
Well, it makes perfect sense. The one with 5%.
That's right.
Yeah,
right.
Makes perfect sense.
So that's what we want to look at. Why? Because when the recession, markets go up and down all the time. So they go in cycles. So we are going to have a market crash. I just don't know when. I don't know how long it's going to last.
Well, we already had one in about a year ago.
Exactly. Right. Yep. So when things like that happen, companies that have very low debt are going to they're going to be able to survive the market downturn.
Right. Exactly.
Right?
And we see this right now, right? We see this with even small businesses. Those who are resilient, they're able, just look at the restaurants, right? You look at the stores that are on the street. Those who closed first, due to the pandemic, means that the business wasn't healthy to begin with. Doesn't mean that they wouldn't have failed. It just means that they weren't healthy to begin with. And this is at a much smaller scale, but sure, the same thing happens, I guess, with anybody. Now, you look at airlines or worse than that, cruise ship companies right now, right, where they're just hemorrhaging money.
Yeah, absolutely.
It's incredible.
Yeah. And so I agree with you 100%. And this is so important. Rule number 8, just to look at the debt. And how long does it take to look that up? It takes like less than a minute, right? You go to Yahoo Finance, put in the ticker symbol, click on balance sheet, look at the long-term debt, grab that number and divide it by the shareholder equity. And that's also in the balance sheet.
Okay.
Right? Just look at it. So we cut it off we want to, like I said in the beginning, you work hard for your money. We want to keep the risk as low as possible. So for rule number 8, I cut it off at 70%. If there's a company that has a debt of more than 70%, we skip it, move on to the next company. Rule number 9. So now we're going to look at the company's credit rating. So for this, we use Standard & Poor's just because it's easy. It's available online. It's free. It's public. You can go on the website. The credit ratings start at like a D. And they go up to AAA, right? So it's kind of like in school. If you get an F, you're not so good as a student, right?
The only thing is that not many companies have AAA.
That's right. So we cut it off at a triple B plus.
Okay.
So if a company has triple B plus or higher, perfect.
Good.
We're good. So anything less than that, we skip it, move on to the next company. Rule number 10, does the company actively buy back its shares? So over the long term, companies that buy back shares, again, in the long term, it's good for the shareholders because share price is going to go up eventually, supply and demand, right? So we got that. Good. Okay. So the first 10 rules, if a company passes the first 10, you know that you have a quality stock on your hands.
Right.
That's how we define quality, is the first 10 rules. Okay. The second part is now we want to know, is the company undervalued today? Right. Everybody says to buy low and sell high. Right.
How do you know?
How do you know? And so rule number 11 is going to tell us that. So it's in 3 parts. Rule 11A. So first we look at the PE ratio. So we want to make sure it's 25 or less. Okay, so that's going to give us good value. Rule number 11B, we take a look at the current dividend yield, and we want to make sure it's higher than the company's average 10-year average dividend yield. Now, again, this is in the course, it's this 45 minutes. We go into detail, we explain the theory and how we
so far, I know just enough to be dangerous when it comes to, I also know enough not to trade stocks myself. I keep telling everybody this. I don't want to have anything to do with it. I've tried. I'm okay at it, but for me, stocks are a casino. But I know that if you do it correctly and you have the discipline, then yes, of course you can do it well. I mean, I have a portfolio manager that does it for me. This person keeps all of the emotion out. And by the way, if you're listening, he's probably laughing right now because, sometimes I'll call him up like in the middle of the night and I'll be like, do I have something to be worried about? And he's like, no, just relax. Much more disciplined about hitting the sell button than I am.
Yeah, that's great. Absolutely. That's correct. I'm really passionate about this stuff. Yeah. I love talking about this stuff. So you're going to have to rein me in because otherwise I'll just keep going.
No, I'm loving this.
I think we're okay on time. So 11B, that's the rule. And 11B is the most important rule of all of them. I never have violated 11B in 21 years.
So the dividend rate currently must not be lower than the 10-year dividend rate of the company currently.
That's right. The average dividend yield. Yes.
Right. So that shouldn't be a problem as long as the dividend keeps going up.
Or even if the dividend remains the same, because the dividend yield is based on the dividend divided by the share price.
Sure.
Right.
Exactly. Yeah. Exactly. Right.
But that's going to give us a good indication that historically, really quick, again, Rick, because I love talking about this stuff, but I'm really quick here. If the 10-year average dividend yield for a company is 3%, okay, and the yield today is at 5%, then the company historically, it's at a low price, right? So that gives us a good indication of value.
Yeah, we saw this with Canadian banks back just in, April and May and June of last year.
Yeah, absolutely.
I think you could buy, I saw CIBC, you could buy them for, I think the payout was like, not the payout, the dividend was like over 7% for a very short period of time. That's right. Yeah. for CIBC, it's like, what?
And 7% is amazing. You can't get that anywhere.
No.
You can't get that in the GIC and bonds. You can't get that anywhere. So that's a great rate. Yeah. Rule 11C is now we look at the PB ratio, the price to book value. So the PB ratio, we're looking at 3 or less. So if it's anything higher than 3, we skip it. Company fails rule 7C and we skip it and move on to the next one.
Got it.
The last rule number 12. And you just touched on this a couple of minutes ago. And so rule number 12 has nothing to do with looking at stocks, nothing to do with financial data, comparing numbers or graphs. It has everything to do with you as the investor. So rule number 12 says, keep your emotions out of investing. And I know this is the most difficult rule.
Yeah. My finger is so quick on that sell button. It's incredible.
Yeah, absolutely.
Yeah, no, I think it's at the end of the day, really, it's something that you get used to. If I chose to trade my own stocks or at least buy my own stocks, because I don't think trading on a regular basis is healthy. And certainly, if you're going to be following these 12 rules, I think you'll be buying, you won't be dollar cost averaging in, for instance, every paycheck. You won't be buying stocks every paycheck. I think in this way, you'll probably accumulate funds a little bit. And by the way, correct me if I'm wrong, but I imagine you'll be accumulating funds until there is a buying point that matches all of the 12 rules, I think.
Yes, absolutely. I mean, we are long-term investors.
I passed. I got it right.
You got it right.
Yeah.
We're long-term investors. This is not day trading. This is not get-rich-quick scheme. Right. This is long-term investing. And so you're absolutely right. We want to wait till a stock is undervalued. It passes all the 12 rules, and that's what we want to invest in. So just to finish off rule number 12, the two key things for keeping your emotions out, you have to have discipline and patience, right? So you have to have the patience to ride out market downturns. So if there are market crashes, the worst time to sell is when stock prices have tanked.
And I would argue to that the patience, not only that, is you have to be patient and disciplined to wait for a buying opportunity.
Yes.
Because some of the mistakes that I've made is said, oh, well, whatever, I'm going to buy the stock today and I'm just going to keep it forever. And it turns out I kept it for like 17 seconds because, but again, I'm sure some people can relate to my own way. I just know, I know that I'm dangerous. That's it.
Well, that's good. I mean, you're self-aware, right?
I'm very self-aware when it comes to that. Yeah. But Kanwal, this is incredibly good advice. And I think that there'll definitely be some value for at least learning how to pick a stock and whether or not it's a fit, because I imagine that for the most part, when we are researching, I'm sure everybody right now who's listening to this is going to be checking out, Coca-Cola, Procter & Gamble, and and Johnson & Johnson, and so on. But they might not be fit. They might not fit all 12 of those marks right now because of the stock prices. Yeah. Right now, the Dow Jones and S&P 500, they're all hitting, and the NASDAQ, they're all hitting records. Almost on a daily basis. So probably today is not the right time to be buying, but it'll provide the investor some experience to be able to go through this list. And when that opportunity comes up, they can at least pull the trigger potentially, which leads me to my next question. Kanwal, you have a course and you teach people how to pick these stocks. Yes. Do you also have another like a newsletter or something that tells people, hey, look, you might want to consider this because it matches all of the 12 rules?
Yes. So in the course, just like you said, I teach everybody the 12 rules. We go through the 12 rules. There's also an Excel spreadsheet. And there's videos step by step. Right. Okay, we're going to take a company like Bank of Montreal. We're going to get all the data together, and I show them in the video how to do that. And go to morningstar.ca, where to get all the data, put it into a spreadsheet, and then apply the 12 rules. So I do that. I've been teaching the course for many, many years. Started in 2007. And then eventually I put the course online. And so the biggest feedback I got was two pieces of feedback. Number one was, I wish I knew this 10 years ago or 15 years ago. And number two is, the course is great, but can't you just tell me which stock?
Exactly. Can't you just do it for me?
Because it's a lot of work.
Sure.
So there's two types of audiences. I mean, there's the do-it-yourself, money nerds like me who like to do this stuff. Yeah. And for those who don't, I have the Simply Investing report. So it's a subscription-based service. Comes out once a month, first day of the month. I track 245 stocks in there, the US and Canadian. Total of 245 stocks, and I apply the 12 rules to each of those stocks every single month.
So out of those 245 stocks, have they all at one point ever matched all of your 12 rules?
Yes. So they've all matched the 12 rules at some point historically, since you've been carrying this. Great, because so we don't have to only look at 3 companies. There's more than 3 companies. That's right. So I'm just, as we were talking here, I just brought up my the February issue, the latest issue of the Simply Investing report. And so for Canadian companies, we have 1, 2, 3, 4, 5 companies today in Canada. Out of the ones that I track, pass all 12 rules. And in the US, we have 1, 2, 3, 4, 5, 6, 7, 8, 9 companies today.
That's incredible.
In the US. That pass all rules. So that really narrows down the list, right? Because there's over 5,000 companies, and it's really overwhelming to figure out which ones do I need to focus on. So I really narrow that list down for everybody. We got 9 in the US, we got 5 in Canada, and so that saves you a lot of time.
It's great advice.
Rick, can I give you a quick example with one of my personal stocks that I've bought, which illustrates the 12 rules?
Sure.
this will only take a minute here. So I bought TC Energy back in 2000, 185 shares.
Okay.
Okay. So not a lot. The share price at the time was $13.40. So if you do the math, it's $2,479.
Right.
So that was my initial investment. And anytime you invest in a stock or even an index fund or mutual fund, I mean, what's at risk is the money you put in. If TC Energy had gone bankrupt, I would have lost $2,479. So that was the money I put at risk. I still own the company since then. The dividend at the time was 80 cents a share. Today, the dividend is $3.24 a share. And I'm a money nerd. I calculate all this stuff.
Sure.
Since I've owned this stock, they have paid me, just this one company, TC Energy, has paid me $6,734 in dividends.
Yeah, so forget about what the share price is. It doesn't matter.
Right.
Double what you paid for it. More than double.
Exactly. Right. So the share price today is $55. Do I care if it drops to 40 tomorrow?
No.
35 or even $10 a share?
No, probably you're buying it. You're probably buying at that point if they match your 12 rules.
That's right. Yeah. So what happened to my risk? Every time I get a dividend payment, the risk comes down. Every time they increase the dividend, my risk goes down.
And now your risk is now at zero.
The risk is zero. Now, if I take the dividend today, $3.24, divided by the purchase price, $13.40, my dividend yield based on the purchase price today is 24%. So that's $600 a year in cash that comes to me from this one company. You can't make 24% anywhere in a GIC, a term deposit, or a bank account.
Right. No, that's hilarious.
Yeah. So I just wanted to share that with your audience because I think it takes time, but we're long-term investors, but you want to get to the point. I have a couple of other stocks that are completely paid off. The dividends have completely surpassed what I initially paid for the company. And that's where you want to be. You want to be at that position eventually.
That is incredible advice. And you know what, I could definitely, I definitely want to take a look at those 12 rules. You have that available on your website?
Yes. I'll send you the link. It's simplyinvesting.com/rules. It's so simple.
Fantastic. Well, we're going to go ahead and put that in the description below, and everybody can take a look.
Yeah.
Great. Well, Kanwal, this has been a very eye-opening half hour. I really appreciate you sitting down with me. I think there's a lot of really valuable information, and if more people knew this, I think it would probably change a lot of minds about investing in stocks.
Yeah, absolutely. Yeah, thank you for Rick for having me, and I agree with you. It's life changing for people, right? Once you understand this and you can invest responsibly. We haven't even talked about mutual fund fees and index fund fees and ETFs. We'll save that for another episode.
That's another video. That's another video.
Yeah,
absolutely.
Absolutely.
Great. Well, thank you so much for hanging out, and I hope to chat with you again.
Awesome. Thanks, Rick.
All righty.
Bye.
Take care.